Palisade Radio is preparing to release an in-depth report on the fundamentals of uranium, including our top 3 picks for 2019. Sign up today at palisaderadio.com to be the first to receive our exclusive report.
Welcome back to another episode of Palisade Radio. This is your host, Colin Cattell. Returning guest on the program today, John Hathaway. He's the portfolio manager of the Tocqueville Gold Fund, a very prominent, sizable fund in the space. John, thank you for coming back on the program to talk to us today.
Sure thing.
I want to start off by talking about the sentiment of the gold market. And this may be a silly observation because maybe it's always this way, but it seems to me right now that gold bugs find themselves in one of two camps, and they're polar opposite. One thinks that gold is ready to move and move up in a big way, and the other one is worried that gold is going to test kind of its low of a couple of years ago before taking off. What's your feeling on the market at this point in time?
Well, I guess I would say... I can think of a lot of reasons why gold should get more of a bid than it's had. And I keep looking for signs in terms of technical inputs that I get. But it's kind of lukewarm. And so I don't have strong conviction about the very immediate, the next couple of months. I do think that when more investors start to think about the deficits that the U.S. is going to start producing, which will be on the $1 trillion kind of, that's a routine deficit number, you'll start to, and the size of funding needs by the Treasury, because the Fed is pulling back from supporting the bond market. I do think that gold will start to get more of a bid. I just don't know over the very short term what to say about that. So I guess I'd be in the lukewarm category, kind of hoping for a good rally, but maybe prepared for one more test of those lows. I don't think we'll go back to the lows at the end of 2015, but I do think, I could see a pullback of, $50 from here, which wouldn't be any fun. And, the stocks, would maybe just sort of revisit their recent lows. So, that's a pretty wishy-washy view, but that's very short term. Longer term, I am very bullish.
Well, I think your view actually mirrors a lot of other people's views that it's just hard to know right now, and appreciate your feedback on that. I want to ask you a question that I've asked several people on the show before, and you've probably been asked many times, but it's at the forefront of a lot of gold investors' minds, which is, if the stock market were to take a fall here, the general stock market, would the same thing happen to the mining stocks that happened in 2008, with the obvious fact that in 2008, the mining stocks were at all-time highs, and now they're at pretty low lows. So a little bit of a different narrative for sure.
Right. Yeah. No, I think you answered the question, because right now it's very easy to find mining stocks that trade at 4 and 5 times EBITDA, just to use a conventional valuation technique. So I don't think they have that far to fall if there were pressure on the broad market, and very different than where we were 8-9 years ago. So I would first of all, I view the weakness in the market as very constructive, and the more of that we see, not so much in terms of the depth of the decline, but just sort of the length of a choppy sideways market, maybe chopping lower, I think that will be very, very good for interest in looking at risk mitigation, protecting capital, which is what gold provides. So, and if the market does crater the way it did back in 2008, and I don't know if it will, but if it did, I do not think the gold stocks would have the same amount of downside that they showed then.
And worth noting is the action a couple of weeks ago when the stock market did take a dive a few days, and I was at least surprised to see that gold did its job and was the only thing up. The dollar was down, the stock market was down, so that must have been refreshing.
Yeah, no, that's encouraging. And one of the linkages that needs to be broken down is the idea that the strong dollar is necessarily bad for gold. That kind of has crept into kind of the conventional wisdom. So, if you watch DXY versus the gold price over the last couple of years, they've kind of moved inversely. But recently, that has not been the case. And gold is showing signs of turning its own course against the dollar. Time will tell, but I would look for that as a clue to see whether gold is going to start to get some legs.
Fair enough. I want to talk to you about the performance of gold producing companies, and I haven't looked at this too closely myself, but I'm just pulling on some comments I've heard from Rick Rule and a couple other people. The bear market certainly forced the gold companies to make some smart decisions and become more profitable, but then some of, and that did show over the past couple of years, some of the earnings that just came out, Goldcorp namely, certainly disappointed the market. And what is your take on the performance of these companies?
Well, Goldcorp was the one that was conspicuously disappointing. Although they had advertised or broadcast a weak quarter, underneath it all, we thought it wasn't that bad, and the market didn't like it at all. But then if you look at some of the other major larger cap names in the space, Newmont would be one, Agnico would be another. Their numbers were pretty good. And so I would say if you wanted to sort of generalize about performance, earnings performance in the precious metal space, it wasn't all that bad. In fact, you can find many instances where the numbers were actually good. So, yeah, I would just say Goldcorp was the standout in terms of being disappointing, and there might have been a couple others, but that was the biggie.
Fair enough. I think it's a good comment to say that in this market, the companies that have been shining, and there haven't been too many, have been discovery-oriented companies, and typically discoveries of pretty sizable grade. And I think investors are aware of that. Looking forward over the next, say, 12 to 24 months, where do you think the best kind of companies are to position oneself to make the most on gold?
Well, I agree that the better performance has come from the exploration kinds of companies. Because there's always excitement around a good drill hole or a sense that a resource is getting bigger. That's always been a way to move stocks in this space. But those tend to be smaller cap, and that's fine. We own many of those kinds of names. But you really cannot put that much capital to work if you're looking for large position size in those kinds of stocks, and there are a number of good ones. The one thing I would point out is that the bigger companies are running out of reserves. The reserve life of the industry, I think, is the least it's been in 30 years. So, companies like Newmont, Barrick, which is now a new company because of the Randgold merger, they're going to hit a brick wall a few years out. And they're going to have to look at these smaller exploration companies to replenish their reserve profile. And that would be a reason to focus on the kinds of stocks you just brought up. So we do see an M&A wave in the next couple of years for that reason alone. So strategically, if you were, and again, this would be a more aggressive investing strategy. I would skew my holdings towards the exploration stories.
What is your feeling on the streaming and royalty companies at this point? It's been clear that in the bear market they've been able to put together a lot of accretive deals, and they've also weathered the storm. But how do you feel that they will perform against, say, the big mining companies when gold starts another leg up?
Well, I think they'll perform fine, but I don't think they will tend to underperform because they've held up better. Each one is a little bit different. But this last several years where the capital markets have basically been shut down in terms of equity capital raises, the royalty companies have had a field day in terms of building up their pipelines. So the fundamentals for the royalty companies, royalty and streaming, are terrific in a weak market of the kind we've had for the last few years. So, that's a very positive comment on their fundamental situation. But I don't think that they will, in percentage terms, perform as well. I think they'll perform well, but maybe not as well as the companies that are more capital intensive, that have been more heavily discounted by these tough markets of the last few years. So it's kind of a short-term, intermediate-term trading view. If you look over time, I mean, the most money that's been made and the most money that's been kept in the precious metal space has been Franco-Nevada, Royal Gold, and companies of that kind. I know it's not a big list, but over time, that's a great business model. And so the comments about relative performance in a restart of the gold cycle, is really more of a short-term, intermediate-term comment.
I recall speaking to Eric Sprott about a year ago, and he was talking about the importance of the commodity price, and that the commodity price as a shareholder would always outweigh the importance of potential production increases. And I guess this would maybe work against Eric's case at this point, but if you're to look at a mining company, say Kirkland Lake, which has outperformed just about every other mid-tier, they have a very low cost of production. And then you can look at a company like maybe Goldcorp right now, which is very depressed, and we'll see a huge move to the bottom line if gold prices go up just $100. What is your way to look at, how to pick the pool of more of an optionality play or just a strong performer?
Well, we in our fund we're across the board, so I don't try to game it all that much. But my expectation would be that if you wanted to say gold prices were going to go up by that amount, $100, you're going to get a bigger percentage return from a Goldcorp than you would from, let's say, something like a Kirkland Lake, which has been a great stock. And the reason is just that a Goldcorp is more heavily discounted, with pessimism on the gold price weighing much more heavily in terms of the valuation and the way investors look at it, whereas in the case of a Kirkland Lake, you've got a great story in terms of reserve growth and continuing discovery and that kind of thing. So, there isn't as much pessimism. There's hardly any pessimism baked into that price. I mean, again, Kirkland Lake has been a great stock over several years now, and, I wouldn't sell my Kirkland Lake just to buy Goldcorp because I thought we were going to get a big bang in the gold price.
Understood. John, I want to ask you at this point in the market, and just being as the market has been for gold investors, that everybody's so beaten up, are you seeing any kind of thing over the last 6 months, any catalyst that has sprung up that you didn't see before, or something that out of the blue could really make this market start to move?
Well, almost by definition, you never see that kind of thing. I try to think of things that will make investors more interested in having the kind of diversification that gold and mining stocks would provide. And I keep coming back to the U.S. fiscal situation, which is quite dire. Most people are sanguine about it. Why is beyond me, but I just don't think, it's going to be in our face for the next several years. We have a very inflationist administration. We'll probably end up with a Congress that is less able to act. If you have a split Congress between the House of Representatives and the Senate, which is what most of the betting seems to be right now, it's a recipe for no action, and that means we're on automatic pilot for trillion-dollar deficits. If you do the math on that, and you look at the funding requirements of what that means for the U.S. Treasury, assuming the Fed continues on its path of balance sheet reduction, you're going to get higher interest rates. And higher interest rates will bring down equity market valuations, and then I think that will cause people to have a greater sense of risk, capital protection, and whatnot, and that will be helpful for gold. So that's a long-winded answer. I don't see, beyond that. There are many things you could talk about: geopolitical risk, things that nobody can forecast. And as usual, there will be, but I think it'll be capital market related. I think it will be whatever it takes to bring the markets down, or more importantly, affect investor psychology so that you get the sort of wearing out factor where the idea that you can just put money to work and it's going to grow in value in mainstream investing. If that changes, that'll be very good for gold. And how it plays out over what time frame, that's certainly not for me to. That's not something I can, or I don't think anybody can forecast. But to me, that would be the sequence where discouragement creeps in terms of mainstream investment strategies. Got to find something different, and I think gold will be one of the things that people go to.
Excellent. Well, on that note, John, I want to thank you for coming back on the program with us, and I hope that when we get you on the next time, there'll be a bit more excitement in the market, so we can have an even more exciting conversation and people will be making more money.
All right. Thanks a lot, Colin.
Think you understand the junior mining sector and you think that the participants in the mining sector, junior mining sector, are good people and kind people, hit the bid.
How violent that term could be, it actually could be quite violent. It could be a rip-your-face-off uranium rally.
And the world is always going to need raw materials. It's going to need copper and gold and nickel and so forth.
Totally destabilized. Hey, Troll, did you hear what's going on in Yemen?